Good morning, guys. June 21st, 2019. It's Friday. So, yes, we are actually considering a couple of day trades today. But considering the VIX environment, we're going to talk about that in detail in just a second. This is not an ideal day to be day trading. What you're going to see the market do over the course of the next few days, it's really going to test your bull patience because it's going to look pre-market in the morning like the markets are always in the red. They look like they're dropping. You're going to be thinking, oh man, why did I get into these calls? And after all said and done, by the end of the day, they're all going to be marching higher. So we're expecting the market to set an all-time high today. Again, we're expecting the market to set an all-time high again on Monday, Tuesday, and Wednesday, ultimately hitting the 3,000 mark on the S&P 500 futures. So here's some key observations. IPO. Looks like all the IPOs recently. Look at Slack yesterday. It's like party like it's 1999 again, guys. That's when the IPOs were going through the roof. In the late 90s, things were just getting out of control, and we're showing signs of that again. So that actually blends in well with our theory of S&P futures reaching 3,300. So when you have situations when the markets just don't care, they don't give a damn. Okay, bad news, good news, they just want to buy. So the best thing to do again is just to step back, get out of the way, and just buy. Buy. Let the bulls buy the market. Just take the right side of the equation and just be patient. Because some days it's going to look like, whoa, hold on. It looks like things are falling. Why am I in these calls? But if you get the longer time expiration, you're going to do just fine. Just stay the course. So we're clearly seeing the shift in behavior at this time when we're visiting these high levels in the markets. And the difference from last two times is the VIX divergence. Yesterday I posted the video on YouTube. You should have the link this morning somewhere. Review that. There's a lot of details in there, but we're going to take a look one more time at this VIX divergence slide. The difference between when the markets were hitting all-time highs last time and this time, there's a substantial difference there. Now, a lot of guys are worried, hey, can the war with Iran take the market down? If you look historically, none of these wars have really produced any negative impacts on the market. As a matter of fact, in instances after initial slight drop, the markets rally in warlike environments. So this could actually be a catalyst for the market to move higher rather than lower. So institutions buy the dip intraday yesterday, and they buy it fiercely. They buy it with full-blown high speed, buy the dip kind of thing. As soon as we hit these levels, which were a resistance just a couple of days ago, the key level is 29.36. As soon as we hit that level yesterday, actually the exact level was 2935.75. So as soon as we hit that level, banks came in, they bought the dip like there is no tomorrow, like it's party like it's 1999 again. And so today pre-market we're slightly down a few points, like 5 points down at the point I'm recording this. Gold is setting a new record above 1,400, new record in relation to the last 14, 15 months of trading. So BYD puts, that's the deal of the day. If you're looking to put in a trade, we're going to talk about that in just a bit. And CGC, Canopy, TLRY in focus today for us. We're actually trying to find out if they are indeed going to buy the dip. TLRY was mentioned in the video 2 days ago as one of the things that, in this type of market environment, these high speculative things, they do well. And TLRY is up from 38 to 48 bucks, so about 20-25% up just in the last 72 hours. CGC reports some rather disappointing news, but the question is, yeah, the stock is down a couple of dollars so far, around 40 level. Are they going to buy the dip? That's what I'm keeping an eye on today, because if they're buying the dip in CGC on what appears to be disappointing news, guys, we are in big time. So far we had many confirmations like an Adobe, no matter how bad the news is, they're saying no growth, they're buying the stock anyways. This market just don't care. And if this market don't care, the only game in town is to be buying calls on the market, calls on some good stocks. Now, BYD is not a good stock because it's up 600%. When something is up 600%, it is going to be a reversal. And we're going to take a look at the chart in just a sec. So the most important slide is this. This orange points right here on this slide, guys, is the VIX. The question is, why do we actually think that this breakout is real? The breakout of the cup and handle, that is. So the first time in December 2017, January 2018, when the market set the highs, the VIX was at the 10 handle. The second time we retest the highs in September of 2018, the VIX is around 15. The third time we're retesting the highs in March, April, just a few months ago, VIX is in the 16s. So this is an uptrend. It looks like a reversal of an uptrend lower as we're setting all-time highs. Yesterday in the market, pre-market, VIX actually dips to 13. We've discussed that in a part of the slide. We're talking about the VIX crash continues. VIX does trade lower despite of it not closing anywhere close to the lows of the day, which were like 13 pre-market, but it does manage to close on the 15, which is in a 14 handle. So as long as the VIX is 13, 14, in comparison to the last time we visited the highs, this is actually lower. So we do have a divergency on the VIX in relation to how the market acted when it got to these high levels. And so what this really tells us is people are not concerned. So the last two times we visited these highs, you probably even heard me say on some videos, hold on, this is a double top, this is a triple top, this is the time to jump on the bear side. And clearly, we noticed that the VIX, the activity in the VIX was pointing to the fact that people were buying protection, that people were fearful at those high levels that the market was going to reverse. We're not noticing it this time. Now, it does not entitle automatically that the market's just going to go up another 100 points on S&P today. However, what it does indicate that the market slowly will grind its way higher. And if you studied the 13 markets move formula, guys, thoroughly, you know that all bearish moves, with the exception of like a 3, which starts with a gap down, all the top-in moves, which we're at the top, so the top-in bearish moves would be important to study and understand thoroughly from the 13 markets move formula. Good example would be like a 2. It starts with a gap higher. So on the mornings when something starts with a gap higher, those are the days you should be highly concerned of a reversal when something trades. In this particular case, we're talking about S&P futures at all-time highs. So when the market actually starts negative for the day, a few points, like 5, 10 points negative, this is actually a bullish sign because what do we know? The predominant behavior is banks are going to come in and what are they going to do? They're going to buy the dip. So those days when the market actually begins in the negative, those are the days where you should come in and buy the dip because that's with 99.9% probability it was institutional investors are going to do in this type of market environment. So remember the cup with a handle, right? The breakout that we've talked about. Again, more details in a separate video on that. Just check that out when you get a chance. So the S&P 500, all of that good stuff. Okay, so the market sets a high yesterday of 29.64. We're actually expecting to break above that level at some point today. And we think that for the next few days, we will continue making all-time highs. Meaning, you know, today we're expecting the market to go above the high yesterday, which was 29.64. Monday, we're expecting the market to go above the high that will be set today. So that trend is going to continue. It does not guarantee, again, a 100-point move higher, but it's reasonable to expect over the course of the next 4 trading days by Wednesday that, you know, if on average we track higher about 10, 13 points on average, that we would hit that milestone of 3,000 on the S&P. Buying calls on cloud stocks on the dips. As you can see, this is a big shift from what we have been doing, guys. With the market environment now, we believe that cloud sector is actually going to make another run higher. We strongly believe institutions are going to come in and buy the dips in these names. So all the stuff we used to short for the last few months, like Workday and CRM and Now and Amazon, we actually want to buy calls on these names the best strategy would be to initiate the positions on the dip. Don't go all out on any particular day. Make sure that you're stair-stepping in the position and giving you options 2, 3, 4 weeks till expiration. This is the deal for today. BYND puts. This was the trade that we explained. Actually, in our High Rollers Club, we took this trade with many subscribers. We stayed with this trade on the put side, basically predicting the drop on Friday. This is the only put position we've maintained, besides a few puts on ALGN as well. Otherwise, we're all in calls now. So BYND puts today. Why today? Well, the chart is really ugly. And number two, we actually finally gave the first negative catalyst. This thing just been so positive. There really hasn't been any negative comments about the stock. So the first day, yesterday after hours, we're getting some independent company just basically says, hey, you guys realize that fake meat is not good for you. Okay? Yeah, hello. Thanks for bringing it up. I don't know why nobody was talking about it before. Yeah, I mean, it's nothing new, right? In chips, like eating fast food stuff, they put all kinds of additives that makes your stuff taste like good. But in reality, none of that stuff is good for you. It's proven to cause cancer, not the fake meat, but certain ingredients that go in it. And so all of a sudden it surfaces, they got ads about it everywhere. So who's behind it? Well, probably meat producers, because they don't want to lose their market share. But it doesn't really matter. What matters is we got a fresh catalyst. We think BYND can trade back to the 130s today. Now, at the point I'm recording this video, it's trading nicely at 159. So we are expecting a drop to the 130s, specifically like 135, 136 area would be a good area to trade this today. And why today? Guys, it's Friday. It's Friday. Your options on these high volatile names are going to be priced a lot less. I mean, trying to buy this thing with an expiration for next week, good luck. I mean, it's going to be priced high as hell. So what we're saying is just buy some puts that expired today, get in at these level in the 150s, close out the position in the 130s. Nice, easy, simple trade. So for those of you that just can't bear the idea, man, Leonardo just wants me to stick with his calls. This is boring as hell. I'm a bear at heart. Give me a chance to buy some puts today. There's it is, guys. Nice and simple trade. We're tracking multiple head and shoulder formations on the 5-day chart. So here's your shoulder, here's your top, here's your shoulder. Here's another top. You know, kind of like we got 2 moves 11s back to back. I think this drop is inevitable. The question is, will we stop at 136 today? Or will we push this level lower and maybe actually drop all the way to the 120. So this is the one to watch today. The money will be made here, guys. Nice and easy trade. June 20th, yesterday, was a move 7. You know, move 7, guys, is the king of buying the dip type move. So here's what we see. This fierce sell-off comes in, and what do? Look at this level, 2935.75. It is exactly the level where the market hit on Tuesday on the way higher and it stopped. This is exactly the level that we hit right after the Federal Reserve announcement on Wednesday, and we didn't break above that. We finally broke above that level in the after-hours session on Wednesday night and Thursday morning yesterday. So what we're actually seeing is intraday, the market retested that level, and as soon as it got to that level, it officially became the level of support. So expect any kind of pullback in the future to get stopped right at this level. So this is your entry on the buy side, buying the calls if the market gets to revisit this 29.36. Highly doubtful. I think what we're actually going to see today is the market's going to break out. Initially maybe open in the lower range, 29.50 or something. Right now, as I'm recording this, it's at 29.58. So possibly we're going to dip a few points, followed by the takeout of these levels from yesterday, 29.64.5. And the significance of this would be if we close even at 29.65 or 29.68 or 29.70, it's going to be all over the news. Everybody's going to be talking about it. Hold on. Maybe, just maybe, this breakout is actually sustainable. Maybe you're going to see more people coming up on television saying, hey, hold on, we're seeing this cup with a handle. we could be going for some substantially higher here. So the increased bullish stock is likely to drive these markets in a way higher as well, because everybody's going to want to get in on this call bus, and FOMO is going to kick in. I mean, it's already, we're seeing it with sky speculative IPOs. When an IPO goes up 50% in one day, like Slack yesterday, guys, it tells you. I mean, the markets are wild, stupid, and crazy. When they're wild, stupid, and crazy, just, buy puts unless you're targeting specific companies. Don't get me wrong, we're overall bullish on the market. It does not mean that we're not going to buy puts on some specific individual names that have particular catalysts specifically driving those particular stocks lower. Yes, we're going to take some shots at those. But move 7, guys, buying the dip. That's what they were doing yesterday. 2-day sequence is stand 7. This is how it looks on the chart. Buying the dip continues. So, and initially, after that announcement, slight spike lower to 29.15. So move lower, followed by them buying that dip and moving the market higher substantially after hours. Buying the dip again. So we're seeing buying the dip, bull run continues. 5-day sequence, just keeps looking green. We have not seen this, guys, in a while. These bullish slides, when I make them and I, try to color code them, this is a definite change in the behavior and the characteristic of the market, because typically you'll get a couple of red moves here, you'll get a couple of green, there's going to be like a good mixture. But this is clearly something is changing when we're hitting all-time highs. Everything is just green, and it's likely to continue because of the picture that VIX is drawing for us. So 5-5-1-10-7, bulls in full control. If we take it a 5-day chart, what do you see, guys? It's buying the dip. They bought the dip here. They bought the dip here. They bought it again here and again here. It's buying the dip. So if they're buying the dip, we should be buying the dip. That's what's going to make the money. Next market move, 8, 4, 7. So if you study the 13 markets move formula, okay, besides the 7, the 4 and 8, they initially start negative. And the difference is when they actually get positive throughout the day. So typically we start negative and then the market grinds higher, and at some point in move 8 we could just move higher, significantly higher by like lunchtime. In move 4 we're going to do it pretty much all the way at the very end of the day. But they are bullish moves. They do initiate in the red territory. They do start with a move lower pre-market or right at the market open, and then they start grinding themselves higher, finishing higher for the day. So they are bullish moves. So we assign a high probability for move 8, 4, and possibly another 7. So multiple days high, likely to start in the red and finish in the green. So just because you see the red in the beginning of the day does not mean, guys, that it's a bear. It does not mean that this is a sign to be buying puts. VIX crash continues. Hits 13s yesterday, but this was the range yesterday. At some point, it got everybody freaked out on the dip. It hits 16.03, but that's exactly where they come in and they buy. So you're now what used to be a level of support on the VIX. It used to get to 16 and then bounce off higher above 16. Now, the moment it hits 16, it actually starts going lower. So now the 16 on the VIX becomes your resistance, okay, on the way higher. So it's interesting how precise these numbers are, because what used to be the support, what used to be the resistance on the S&P at 29.36 is now the support. And what used to be the support on the VIX here on the way down, working for the 16, is now the level of resistance. So interesting how these things coincide right at these levels that we keep track of. So very likely what we're about to observe on the VIX is just a simple trend sideways. We had a couple of interesting moves where we set the low at 13.19 per market yesterday, 1603 right here. So in this range, so 14, between 13 and 14. And clearly, if VIX is trading sideways, it is not a perfect just directional day to be trading directional like SPY contracts or something like that. So again, it's better because the overall move is going to be higher in the market. It doesn't mean that these intraday dips are not going to eat the option premiums. So therefore, it makes sense to give yourself some more time frame when you buy these contracts, guys. So the key takeaways is very simple. Just focus on buying intraday dips. Be patient. Get more time on these expirations. We are looking for a break above 2964 by 12 p.m. today and 3,000. S&P 3,000 by some point on Wednesday, possibly Thursday. Guys, with that said, focus on the dips, short the hell out of BYD, make some money, be patient with this market, and the results will follow over the course of the next few weeks. I'll see you guys on the next video.